Swift is an absolute giant. They have over 11,500 institutional clients tied directly into their network. This is where money actually moves every single day. These are the global rails. This is one of the most dominant players in the entire financial system. And now they are changing how money itself moves. This is not speculation. This is not hype. This is real infrastructure evolving in real time. And what Swift just did quietly sent a signal to XRP, blockchain, and the entire crypto space, but not in the way most people think. For years, people have underestimated how slow-moving institutions prepare for massive change. They don't announce revolutions overnight. They test, they pilot, they align standards, they bring everyone along together. That's exactly what you're seeing now. Swift isn't reacting to crypto. Swift is integrating blockchain because the future system demands it. And once you understand that, the entire narrative around XRP, tokenization, and digital rails snaps into focus. Before we go any further, I want to be very clear about something. The biggest money-making opportunities never show up when everyone agrees. They show up when infrastructure is being built quietly before the crowd understands what it enables. That's exactly why I built the 100x formula. It's a simple system that shows you how to identify early-stage stocks and assets positioned to ride massive structural shifts like this one before they explode. It's designed to help you find real 100x opportunities and genuinely change your financial life without complexity. It's in the video description. Now let's get into why this Swift announcement matters so much. First, Swift innovating with blockchain is not new. This didn't start yesterday. This has been years in the making. As far back as 2024, Swift was openly talking about settling digital securities using its own payments infrastructure. That alone tells you everything. Digital securities only work at scale if the settlement layer evolves. You cannot tokenize trillions of dollars of assets and then settle them on outdated rails. The math doesn't work. The speed doesn't work. The transparency doesn't work. Swift understood this early. They started exploring a multi-ledger environment, essentially a system where multiple blockchains, platforms, and financial networks coexist and communicate with each other. If that sounds familiar, it should. That's the same architecture the BIS has been talking about for years. Unified ledgers, interconnected ecosystems, a financial internet instead of siloed databases. This is where a lot of people immediately jump to conclusions and say, this is where XRP comes in as the bridge currency, and look, there is logic there. Ripple has been talking about the Internet of Value for over a decade. The idea that you'll have walled gardens, private ledgers, public blockchains, institutional systems that all need a neutral way to exchange value. A bridge asset makes sense. But here's the part that separates serious analysis from opium. Just because the architecture needs a bridge does not mean we already know which asset wins. XRP has a strong probability. It is well positioned, it is fast, liquid, compliant-focused, and deeply integrated with institutions. But probability is not certainty, and Swift's announcement is not a direct endorsement of XRP. What it is, however, is something arguably more important. It is the green light for blockchain itself at the highest level of global finance. Swift recently confirmed that it is actively building a blockchain-based ledger into its infrastructure, working with over 30 global banks to design it. Let that sink in. This isn't a sandbox experiment with a couple fintechs. This is a coordinated effort with major institutions that already move most of the world's money. Swift connects more than 11,500 financial institutions across over 200 countries. If Swift changes, the world's financial plumbing changes with it. That's why this matters so much. And this announcement wasn't buried in a blog post. Swift's chief business officer openly talked about it on SEO TV alongside Standard Chartered, the same bank that was an early Ripple investor and continues to build crypto custody and tokenization infrastructure today. These relationships aren't random. Banks don't experiment at this scale unless they are confident the direction is irreversible. Now, here's where a lot of misinformation starts spreading online. You'll see headlines saying Swift is choosing Ripple or adopting XRP. That is not true, at least not right now. Swift has clearly stated they are collaborating with Consensus for the first phase of the prototype. That confirmation came months ago. There is no secret XRP integration happening behind closed doors that somehow no one can verify. And honestly, that's fine, because focusing on which blockchain Swift uses today completely misses the bigger picture. Swift is not building a single chain future. They are building an interoperability layer, a system that can settle across multiple ledgers, multiple token standards, multiple asset types. That's why this is so important for the entire crypto ecosystem, not just one token. This also ties directly into ISO 2022, which Swift has been aggressively pushing. ISO 2022 is not just a messaging upgrade, it is a data revolution. It introduces rich, structured data that allows systems to actually understand what a transaction represents. Not just that money moved from point A to point B. Why does that matter? Because tokenized assets, on-chain settlement, compliance, and automation all depend on high-quality data. You cannot automate a trillion-dollar financial system on vague message formats built decades ago. ISO 2022 is the bridge between traditional finance and digital finance at the data level. Deutsche Bank recently talked about how critical Swift's data quality tools have been in their ISO 2022 migration. They weren't just converting old message formats. They were rebuilding how data flows through their entire operation. Visibility, compliance, transparency, automation. This is the foundation layer. And once that foundation exists, plugging in blockchain-based settlement becomes not only possible, but logical. That's why Swift's next step is so telling. They openly stated that Swift will take the lead at the infrastructure level, ensuring the technology exists while collaborating with financial institutions and central banks to choose the best settlement models and the best tokens for exchange. Read that again. They said tokens plural. This is not about one asset replacing everything. This is about a system where multiple tokenized representations of value, currencies, securities, deposits, commodities move across interconnected ledgers. That is a multi-chain world by definition. This is where a lot of people get stuck emotionally. They want one winner, one chain, one token to rule them all. That's not how global systems work. The internet didn't replace all networks with one protocol. It connected them. Finance is going through the same transformation. Some institutions will use permissioned ledgers. Some will use public blockchains. Some will use hybrids. But all of them will need interoperability. They will need oracles. They will need bridges. They will need liquidity layers. They will need standards. That's why Swift greenlighting blockchain is bullish for XRP, Ethereum alternatives, Chainlink, Hedera, and the broader crypto infrastructure space. And yes, Ethereum specifically is unlikely to handle this entire scale on its own. That's not an opinion, that's physics. Fees, congestion, and latency matter when you're settling real-world value at global scale. Efficiency wins over ideology every single time. This is why the BIS has been so vocal about unified ledgers. This is why Swift initially proposed a multi-ledger platform. This is why everything points toward a future where value moves across many networks, but feels seamless to the end user. Now let's address another common argument. Some people say these banks are just building private blockchains. They don't care about public crypto. That's partially true and completely irrelevant. Yes, institutions will absolutely build private or permissioned systems. They always do. But private systems don't exist in a vacuum. They still need to connect to public markets, public liquidity, public assets, and global counterparties. Walled gardens still need gates, and that's where public blockchains come in. No matter how many private ledgers exist, value will still flow across public networks. Liquidity will still live there. Settlement finality will still rely on open systems. The idea that public crypto gets sidelined is a misunderstanding of how interconnected finance actually works. This is why the focus shouldn't just be on Swift itself, but on everything connected to it. Take Chainlink, for example. Swift has already collaborated with Chainlink in the past. Chainlink works with the DTCC. Chainlink connects blockchains to real-world systems. It acts as the glue between data, settlement, and execution. Chainlink also collaborates directly with Ripple. Ripple's RLUSD stablecoin has been integrated into Chainlink standards, meaning it can plug into DeFi protocols, lending markets, and cross-chain systems. That exposure matters. Hydera is also integrated into Chainlink, and dozens of other blockchains are as well. This is what an ecosystem looks like when infrastructure is being built properly. Then you have Ripple's acquisition of Medico and the broader custody push. And beyond that, the acquisition of G Treasuries, a platform deeply integrated with global banking workflows. G Treasuries is a Swift certified partner. It provides Swift connectivity, IBN and ABA lookups, and direct integration into banking systems. It already connects over 13,000 banks globally. That is bigger than Swift's own direct network. So when people say, what if Swift replaces Ripple? They are asking the wrong question. Ripple isn't trying to replace Swift. Ripple is embedding itself into the financial system at multiple layers: custody, liquidity, treasury management, tokenization, and interoperability. Swift evolving actually complements that strategy. This is not a zero-sum game. This is convergence. Everything you are seeing right now, ISO 2022, tokenization pilots, blockchain settlement, unified ledgers, interoperability standards, is pointing to the same conclusion. A new financial system is being built in plain sight. By 2030, over $10 trillion worth of assets are expected to be on-chain. Digital rails will dominate how value moves globally. We are not late. We are early, but the acceleration has started. And this is exactly where understanding infrastructure shifts gives you an edge as this moves forward into how value, liquidity, and opportunity will actually flow next. Because once infrastructure is in motion, everything built on top of it starts moving faster than people expect. What most retail investors never realize is that wealth is not created when a technology is invented. Wealth is created when that technology becomes invisible, when it's embedded so deeply into systems that no one questions it anymore. That's where we are heading now with blockchain tokenization and digital settlement. Swift's move isn't about headlines, it's about inevitability. Think about how Swift has always operated. It doesn't chase trends, it standardizes them. Swift exists to coordinate, not to speculate. When Swift commits resources, collaborates with central banks, and brings 30-plus global banks into a shared design process, that's not an experiment. That's pre-deployment. That's governance alignment before scale. And this is where the timeline matters. For years, crypto lived on the edge of finance. It was volatile, experimental, and largely disconnected from real-world settlement at scale. That era is ending, not because crypto won, but because legacy finance realized it cannot modernize without it. Tokenization, instant settlement, atomic swaps, programmable money. These are not nice-to-haves. They are requirements in a global 247 economy. Swift adding a blockchain-based ledger is a direct response to this pressure. But here's the key insight most people miss. Swift is not becoming a blockchain company. It is becoming a coordinator of blockchains. That distinction changes everything. Swift doesn't need to outperform Ethereum, XRP-PL, or any other chain. It needs to connect them. It needs to abstract complexity away from banks so institutions can interact with tokenized assets without rebuilding their entire tech stack. That's Swift's superpower. And once that coordination layer exists, value starts flowing differently. Instead of slow correspondent banking chains, you get near-instant settlement across ledgers. Instead of siloed liquidity, you get interoperability. Instead of manual reconciliation, you get programmable finality. That's not theory, that's operational efficiency. Now let's talk about why this accelerates adoption across the entire crypto ecosystem. Banks don't move alone. When one global institution upgrades infrastructure, counterparties are forced to follow. Compliance frameworks update, liquidity providers adapt, custodians expand services, market makers position ahead of volume. This is a cascade effect. ISO 2022 is the data backbone. Swift is the coordination layer. Blockchain is the settlement engine. That trio defines the next era of finance. And once that engine turns on, the question stops being, will crypto be used, and becomes, which assets capture the flow? This is where efficiency, liquidity, and integration matter more than branding or hype. Public blockchains with low fees, high throughput, and regulatory-friendly design become far more attractive. Interoperability protocols that can route value and data across chains become essential. Oracle networks that connect off-chain events to on-chain execution become non-negotiable. That's why Chainlink keeps showing up in every serious institutional pilot. That's why Ripple keeps acquiring infrastructure instead of chasing headlines. That's why Hydera, Avalanche subnets, and other high-performance networks continue gaining quiet traction. And it's also why Ethereum, despite its dominance, will not be the only rail. It doesn't need to fail to lose exclusivity. It just needs competition that does some things better. A multi-chain future isn't a threat. It's a requirement. Now zoom out even further. Tokenization is the real prize here. Not payments, not remittances, assets. When stocks, bonds, real estate, commodities, treasuries, and derivatives move on chain, settlement becomes instant, fractional ownership becomes trivial, and global access explodes. That's trillions in liquidity being unlocked. Swift has already acknowledged this by focusing on digital security settlement. That's not retail crypto, that's institutional capital markets. And once assets are tokenized, everything downstream changes. Collateral becomes programmable, margin becomes real time, risk becomes transparent, liquidity becomes global. That's the system banks actually want. Not because it's flashy, but because it reduces friction, cost, and counterparty risk. Now consider what happens when this intersects with central bank digital currencies, tokenized deposits, and regulated stablecoins. Suddenly, money itself becomes interoperable with assets at the protocol level. Delivery versus payment happens atomically. No settlement risk, no T+2, no reconciliation delays. This is not financial advice. That's the end game. Swift collaborating with central banks to choose settlement models tells you they are designing for that world, not patching the old one. And again, this does not mean Swift replaces crypto. It means crypto becomes part of the plumbing. That's the biggest psychological shift people need to make. Crypto doesn't need permission anymore. It needs integration. And integration is exactly what's happening. This is also why the idea of private blockchains replacing public ones doesn't hold up. Private ledgers are efficient internally, but they lack global liquidity, open access, and composability. They are optimized for control, not reach. Public blockchains provide reach. The future is hybrid. Private systems for internal operations, public networks for settlement, liquidity, and interoperability, standards like ISO 2022 to connect them, coordination layers like Swift to orchestrate them. Once you see that, you stop asking whether XRP, Chainlink, or other infrastructure assets win outright. Instead, you ask how value flows through the system and who collects fees, liquidity premiums, and network effects along the way. That's where real opportunity lives. This is also why timing matters more than narratives. By the time retail investors feel safe buying into these trends, the infrastructure phase will already be priced in. The asymmetry exists now during the build-out, not after full deployment. Institutions don't front or run themselves. They accumulate quietly, build partnerships, run pilots, and standardize before scale. Retail reacts after the fact. And that brings us back to Swift. Swift doesn't announce revolutions, it certifies them. Once something becomes part of Swift's roadmap, it becomes part of global finance's roadmap. Period. So, no, Swift didn't choose XRP yesterday. No, this doesn't mean one chain rules everything. And no, this isn't the end of Ripple or the beginning of some replacement. This is convergence. Legacy finance is absorbing blockchain the same way it absorbed the internet. Slowly, cautiously, and then all at once. And when that switch flips, the winners won't be the loudest projects. They'll be the ones already integrated, already compliant, already efficient, and already positioned where value flows. That's the real takeaway. This is why studying infrastructure matters more than chasing price. This is why understanding standards matters more than hype. This is why patience beats prediction. And this is exactly the kind of structural shift that creates generational opportunities. Not overnight pumps, but sustained compounding growth as systems scale. If you can identify the assets and companies positioned at the core of these transitions before mass adoption, you put yourself on the right side of the curve. That's the difference between hoping and positioning. And that's exactly why I built the 100 times formula. It's a simple framework that shows you how to identify stocks and assets aligned with massive infrastructure shifts like this early, clearly, and without noise, so you can capture real 100x opportunities and change your life. It's in the video description.